Topic focuses on measures of risk and performance used to evaluate investment strategies, portfolio management decisions, and alternative investment outcomes. The program explains that investment performance cannot be assessed solely by returns because investors must also understand the level and type of risk undertaken to achieve those returns. Risk measurement techniques help investors evaluate volatility, downside exposure, diversification benefits, and portfolio efficiency. The topic covers value at risk, benchmarking, performance attribution, ratio-based performance measures, risk-adjusted return metrics, and issues involving pricing and historical data analysis. These concepts provide essential analytical tools for assessing investment quality and supporting informed portfolio management decisions. A major topic is the measurement of investment risk through volatility and downside risk analysis. Standard deviation and variance are widely used to measure the dispersion of returns around their average values, providing insight into total portfolio volatility. However, the program explains that alternative investments often exhibit non-normal return distributions, making traditional volatility measures less effective for capturing downside risk. Additional measures such as semi-variance, semi-standard deviation, and target downside deviation focus specifically on negative return outcomes that concern investors most. These techniques improve risk evaluation by distinguishing harmful volatility from favorable upside fluctuations. Accurate measurement of downside risk supports more effective portfolio construction and risk management strategies within alternative investments. The program also introduces value at risk (VAR), which estimates the maximum expected portfolio loss over a specified time horizon at a given confidence level. VAR has become a widely used risk management tool among financial institutions, hedge funds, and institutional investors because it summarizes complex portfolio risks in a single statistical estimate. The topic discusses different approaches to estimating VAR, including historical simulation, variance-covariance methods, and Monte Carlo simulation. Although VAR provides useful information regarding potential losses, the program emphasizes its limitations, particularly during periods of extreme market stress or for investments with illiquid or non-normal return distributions. Professionals must therefore supplement VAR analysis with stress testing, scenario analysis, and qualitative judgment. Topic further explores benchmarking and performance attribution techniques used to evaluate investment manager skill and portfolio performance. Benchmarking compares portfolio returns against relevant market indexes or target portfolios to assess whether managers add value through active investment decisions. Performance attribution separates returns into components attributable to asset allocation, security selection, market timing, or other strategic factors. The program explains that alternative investments often require customized benchmarks because traditional market indexes may not accurately reflect unique strategy exposures or illiquid asset characteristics. Effective performance attribution helps investors identify sources of returns, evaluate manager effectiveness, and determine whether results are consistent with stated investment objectives and risk exposures. The program additionally examines ratio-based performance measures and risk-adjusted return metrics. Ratios such as the Sharpe ratio, Sortino ratio, and return on value at risk compare portfolio returns relative to different measures of risk. These metrics allow investors to evaluate whether higher returns adequately compensate for greater volatility or downside exposure. The Sharpe ratio measures excess return per unit of total risk, while the Sortino ratio focuses specifically on downside risk. The program highlights that alternative investments may exhibit return smoothing, stale pricing, and serial correlation, potentially distorting reported risk-adjusted performance measures. Professionals must therefore interpret these metrics carefully and recognize the influence of illiquidity and valuation methods on observed investment results. Finally, topic emphasizes the importance of accurate pricing data and historical analysis in measuring investment risk and performance. Alternative investments often rely on appraisal-based valuations or infrequent pricing, which can artificially reduce reported volatility and obscure true economic risks. The program discusses issues such as smoothing, stale prices, and serial correlation that may distort statistical analyses and performance evaluations. Investment professionals must therefore adjust methodologies appropriately when analyzing illiquid assets and alternative investment strategies. Comprehensive risk and performance analysis requires combining quantitative techniques with sound judgment and qualitative understanding of investment structures. Strong performance measurement practices improve transparency, support informed decision-making, and enhance portfolio management effectiveness within increasingly complex global financial markets.